Hi, very good afternoon to everybody. So, thank you for joining us on our weekly Monday morning call. So, for today, we have a stock. For today's update, we have stock initiation on Sembcorp Industries by Terence, followed by SG Rates Monthly by Natalie, Asia Technical Outlook by Warren, and then lastly, SG Weekly by our Head of Research, Mr. Paul Chiu. So, without further ado, I'll pass my time and mic and the speaking time to Terence. He will share more about Sembcorp. Thank you, Terence.
Hey, thanks, Warren. And a good morning to all. Once again, welcome to Phillip Securities Research Morning Call Briefing. We initiated on Sembcorp Industries last week with a target price of $1.75. In our next slide, we provide a background of Sembcorp Industries and their recent transaction. Sembcorp Industries should need no introduction. Following the spin-off of Sembcorp Marine last week, Sembcorp Industries is now a leading energy and urban development group. We are also giving an update to our presentation on Sembcorp Marine last week. And last week, they announced that their rights issue, Sembcorp Marine's rights issue, was undersubscribed. This means that Sembcorp Industries have actually, pursuant to the circular, subscribed for more than their entitlement of Sembcorp Marine's rights shares for a total of 1.5 billion Sing dollars. And they have done this by setting off the outstanding principal of $1.5 billion that was issued to the Marine Group under the subordinated loan extended to them. And since the shares were undersubscribed, Temasek has also subscribed for the rest of the unsubscribed right shares, about a billion unsubscribed right shares in total. So, following the deconsolidation of Sembcorp Marine from Sembcorp Industries last week, through the distribution of Sembcorp Marine's shares to Sembcorp Industries shareholders on the 11th of September last Friday. You can see here that on the table on the right, we've summarized the key dates of the crediting of Sembcorp Marine shares to the Sembcorp Industries shareholders below. So the demerger has been completed. 4.911 of Sembcorp Marine shares have been distributed to entitled SCI shareholders for every one SCI share held, assuming that the SCI shareholder held the shares through the ex-distribution before the ex-distribution date. In our next slide, we cover our investment thesis of Sembcorp Industries. We believe Sembcorp Industries shareholders could realize a total of $2.64 per share. It is important to note that our $2.64 per share includes the 4.911 Sembcorp Marine shares that have been distributed to Sembcorp Industries shareholders. But on a standalone basis, we value the standalone Sembcorp Industries, stripping out Sembcorp Marine shares from the equity value of Sembcorp Marine shares at 0.7 times financial year 21 price to book value. We'll elaborate a little bit more on why we use 0.7 times FY21 equity value later on at the back. But the $2.64 fair value is arrived at by taking 0.7 times FY21 equity value and then we add up the 4.911 Sembcorp Marine shares together to get $2.64. We also think that the IPO of Sembcorp Energy India Limited will also crystallize the value of Sembcorp Industries India business unit, which we estimate to have a value of about 98 billion Indian rupees, or about 1.8 billion Sing dollars. Again, we'll elaborate on how we arrived at our valuation at the back later. And we think that we see a potential positive re-rating of Sembcorp Industries following the demerger as profitability and return on equity metrics improves in financial year 21 as the group deconsolidates from Sembcorp Marine from their shares. In our next slide, we cover why we think the Sembcorp India IPO will come sooner rather than later. So Sembcorp, that's a bit of background. Sembcorp had intended to file for the IPO the red herring of their IPO of their Indian business in 2019. This, however, was delayed in favor of an equity injection for a full control of their business in December 2019. And this was done at 1.2 times of their full year 2019 book value, or a 1.4 billion dollar valuation. So with this equity injection to take full control of Sembcorp Energy India, what the group have now is the flexibility to engage in a myriad of different corporate actions that they deem to be most attractive to Sembcorp Industries. This can include listing the shares or even selling it to a strategic shareholder. So the options are there are a few options on the table, and we, as full and sole owner of Sembcorp Energy India now, we think this will give Sembcorp more leeway to run. So we think it will happen sooner rather than later, because we think Sembcorp Industry is now waiting for the right equity window to list Sembcorp Energy India. And over the years, we have seen improving operating metrics. We'll go to that later. What we've done is to generate a list of some of the comparables of sale in India. And you can see this in a table on the left. And we found the sector average to be about 1.7 times price to book value. So we imputed a slight discount to account for sales lack of a listing track record in the market, to arrive at a valuation of about 98.1 billion Indian rupees, or 1.5 times their financial year 19 book value. So slight discount to the 1.7 times we see in the industry. But that as we explained before, is because of their lack of listing track record. So slight discount. But even at a slight discount, they are trading about 1.8 versus their current market capitalization of about 2.1. So you can see that the India business is really huge. In the next slide, we touch on the potential positive re-rating of SCI following the demerger. But for financial year 20, I think we expect revenue from the energy segment to be weaker than financial year 19, and this is because economic activity from around the world slowed down because of various circuit breaker measures that are taken all around the world. So for the first half of financial year 20, revenue from the energy segment actually declined by 17% on a year-on-year basis. We're expecting a slight improvement for the second half because most economic activities have opened up, and we see a pickup in energy and power demand in second half, but full year 2020 will still be slightly weaker because of the slowdown in economic activity from around the world. But we do expect sales net profit also to be impacted slightly for financial year 2020. You can see we provided a graph. You can see that for financial year 16 to financial year 18, sale was actually experiencing a loss for financial year 18 to the tune of about 5 billion Indian rupees. But financial year 19, we've seen the operating metrics improve. Financial year 20 should actually would have seen a boost in the net profit, if not for the slowdown in economic activity in India, of course, because of the opening of sales, the launch of Sales Project 3. So the launch of Sales Project 3 should have given it a boost, but because of the economic activity, it was negatively impacted a little bit. But for financial year 21, we do expect net profit SAIL to continue reporting a net profit, and the net profit margins to also improve from FY21 onwards. Overall, following Sembcorp Industries' demerger from Sembcorp Marine, we do expect their operating metrics to improve. You can see this on the table on your right. So you can see profitability metrics improving, but the overall ROE, return on equity, will improve from 3.5% in financial year 19 to a 7.6% in financial year 21 as the group deconsolidates the loss and also see an improvement in the overall energy demand. In our last slide, we cover our valuation on Sembcorp Industries. And we pegged stand-alone Sembcorp Industries ex Sembcorp Marine, without Sembcorp Marine, to 0.7 times their price to book value. So that's a 0.3 times discount to their book value based on their financial year 21 equity. So we used 0.7 times price to book value because this is a slight discount to the 10-year historical average of the implied Sembcorp Industries group without Sembcorp Marine. So we do this by looking at the price to book value band and look at how it has traded when we strip out Sembcorp Marine, and we get a 10-year historical average of about 0.8 times. So what this means is how investors have valued the Sembcorp Industries group in the last 10 years without the marine business is at about 0.8 times. So we think 0.7 times is fair. It's also a slight discount to 0.8 times. So to preempt any questions, we put a slight discount because we think confidence in management will take time to realize. And so in terms of executing the business in the new SCI standalone group. So slight discount, but we've already see a slight potential positive re-rating of Sembcorp Industries, the standalone Sembcorp Industries, post deconsolidation on Friday, from $1.02, which was their ex-distribution price, but it's now trading about 118, 119. So up nearly 20% from their ex-distribution price from improving operating metrics post-demerger. Entitled Sembcorp Industries shareholders have also been credited with 4.911 of SCM shares for every one share held as at the 11th of September last Friday. So in total, we have a table on the left. SCI shareholders could realize a total of 175, which is 0.7 times their financial year 21 book value. And summing up Sembcorp Marine's last traded price on the 10th of September. And so we use 10th of September because that's the last traded price before the distribution in specie by Sembcorp Industries. So we want to stress we did not perform a valuation on Sembcorp Marine. We've only used the last traded price of Sembcorp Marine for the avoidance of doubt. And then we take the last traded price multiplied by the distribution ratio of 4.911 to get 89 cents. And then when we sum it up, we think shareholders will realize a total of $2.64. I'll now pass on the time to Natalie, who will bring us through the REITs Monthly. Natalie, over to you.
Hi, good morning, everyone. Okay, so we're talking about REITs Monthly today. Next slide, please. So this is how the the REIT Monthly has this is how the REIT index has been trading against the FTSE Developer Index as well as the STI. So as you can see, we are currently outperforming both the other indices. Okay, once again, the FTSE REIT index, as well as the dividend yield spread shown below. So actually, for the past 4 months, the REIT index has been trading sideways. Similarly, the yield spread has also been sideways. For the month, presently, the dividend yield spread is at 4.5%. So this compares to last year, where it was also around 4.6% at an average. The dividend yield spread is almost 100 basis points higher year on year. So this is due to the lower interest rate environment, of course. So dividend yield spread presently is about 3.5%, and this compares to last year's average of 2.6%. So the recovery by subsectors is nothing much has really changed. The healthcare and industrial are still the two sectors that are trading above the January prices, so they're registering again year to date. Of course, if you actually look closely, the industrial subsector has the prices for the industrial subsector has sort of gone down a little bit. So we think that this is due to profit taking. So retail, commercial, diversified are somewhere in the middle. So still down year to date by about 20%. And hospitality is the laggard here, down by almost 40%. So overall, our sector views are more or less unchanged. We still expect slower leasing activity and mostly renewals and higher vacancy rates. Rents are expected to be slightly lower and possibly negative. Although the markets were frozen earlier, especially during the circuit breaker period, I think right now we've seen an uptick in the number of deals and acquisitions that have gone past, so or rather materialized within the last few months. So this is starting to look more positive in terms of the transaction front. In terms of mitigations or mitigants, we see that the tenants are still locked in by existing leases. So these are contractual in nature. And there's relatively low supply coming online from the subsectors, especially in Singapore. And the construction slippages will help to provide some near-term support. But overall, we are of the view that the supply will help to adjust so that the real estate sector will achieve a healthy equilibrium. So jumping into subsectors, first of all, for the office subsector, we believe that the maintenance of the office address will remain the dominant trend. So in the graph on the left, you can see that this is the increase in the office supply over the next few years. For FY 2020, the supply coming onto the market is only 1% of the existing stock, so that's relatively muted in our view. And for the years 2021 to 2022, we do expect some companies to take advantage of the incentive schemes to unlock additional GFA. So there are several schemes. One of them is the CBD incentive scheme, which AXA Tower as well as Fuji Xerox Towers will be embarking on. So this means that the amount of supply, as you can see in the brackets, for AXA Tower 700,000 square feet, as well as Fuji Xerox 354,000 square feet. This will be taken offline. Similarly for Central Mall as well. So in our graph above, it hasn't yet taken into account the removal of these supplies. So of course, the resilience of office stems from the resilience of the office using tenants, and also of course mentioned that there's muted supply coming online, and office will remain relevant because it is synonymous with mentoring, collaboration, innovation, and corporate culture. So these are the reasons why we think that the dominant trend will tend towards office still. So of course, I'll touch briefly on this. The potential positives are lower desk densities and split offices, which may increase the demand for flex space. And so potential negatives is we do expect actually some higher vacancy rates due to occupiers experimenting with different kind of occupier strategies, such as maybe perhaps more flex work or remote working. So for the retail subsector, as you can see, there's a V-shaped recovery in the retail sales index. So the retail sales index for June 2020 is currently down by about 7.2%. So it's almost at pre-COVID levels. And this improvement in the RSI was largely due to the pickup in discretionary spending. So the likes of your household furniture, jewelry, fashion, departmental stores. So these were the categories that were sort of lifting the retail sales index. In phase 2 of the circuit breaker, or rather the lifting of the circuit breaker in phase 2, about 95% of tenants were operating, and we noticed that the F&B dine-in was recovering well, and there was a postponement and not cancellation of spending. So despite the capacity constraints that were in place in malls due to social distancing requirements, we noticed that there was a more balanced customer flow throughout the day instead. Okay, so this is the graph on the right actually shows us the online portion of sales with respect to the F&B category as well as the trade category, the retail trade category. So in July was when was like 1 month into the lifting of phase 2. So you can see that the online sales for food and beverage actually fell by almost 20%, about half of what it was in the month of May. Similarly for the retail trade, which is now currently at 11%. Previously it was around like 25%. So this actually bodes well for traditional retail. You can see that at least within Singapore, it seems to be trending back towards physical spending at shopping malls. Next slide, please. So for our last subsector, which is hospitality, so currently there are, if you look at the graph on the left, you can see that the visitor arrivals is still persistently almost 100% down year on year, which is not surprising. As for RevPAR, there has been uptick in the recent months. So this uptick actually for July came, we think that it came partly because of the government allowing hotels to take staycation bookings. So for this higher RevPAR was due to both the improvement in occupancy as well as higher average room rates for the luxury, upscale, and mid-tier subsectors, or rather segments. We also do expect this staycation demand to sort of pick up more in the coming months, especially with the borders remaining closed and the pent-up travel demand. The recovery of the hospitality sector, of course, largely hinges on the vaccine timeline. This is our Phillip Securities stock calls. So amongst all our calls, we actually feel more strongly about Manulife as well as Prime. This is because of the long whales of almost 5 years that the US office assets face due to the longer leasing cycles in the US. And not to mention these two REITs, they own Grade A as well as trophy assets that are more stable throughout the cycles. Okay, that's all for this slide. Next, I'll pass the time on to Wei Ren.
I'm sorry, was muted earlier on. So thank you, Natalie, for kind sharing. So for today, I'll just share on the Hang Seng Index, both the weekly chart and the daily chart, and then followed by Tencent. Then after that, I'll share on Top Glove and then AEM, one of the popular stock in SGX. So without further ado, let's look at the Hang Seng weekly chart. So for the Hang Seng weekly chart, we are looking at a 5-wave up since mid 2015 to late 2017. And from there on, you have closes below 30,000 since the start of 2018. It has been on a downward channel, potential 5-way downward channel. Currently, look at it on the black color side, on the A, B, and the C, which highlighted in black. We are looking at price making a midterm upside to test the resistance zone at 28,000. And then subsequently the major support and rebound will be at 20,302 to 21,166. Right. So the next slide on the daily chart. Okay, on the daily chart, okay, a false breakout has already occurred on the broadening wedge, and based on the price now, as of Hang Seng is trading right now, I think Hang Seng has made a rebound upside to within the broadening wedge, and therefore I think that the price movement is should it close below 25,489, which is the 200 day moving average in the next few days. I think prices will continue to fall towards the support zone 1, and should support zone 1 doesn't hold strongly, then we will think that the support zone 2 will be the next rebound, which is roughly the same as what we thought on the weekly chart earlier on. All right, so that's all for Hang Seng. Then I'll move on to Tencent, the next chart. So Tencent actually is quite an interesting stock. I think it's the most strong bullish stock that we have seen this year. I think as compared to last year we have a lot of proactive action within Tencent, and prices still fails to break above 300 Hong Kong dollars around that region. I can't remember. So but as of July and as of mid-July and end July, prices has failed to advance above 550 for 3 times. And then initially we thought that this will be a ascending triangle, and then prices going to do an extended wave 5, but in the end prices had a huge fall on the start of August, where you can see a long long bearish candle down after the two hangman near wave B highlighted. And then we thought that it's going to be a triple top, but a triple top did materialize a bit, but price after that, after the price actually rebounded from the neckline resistance turn support at 516 region. All right, but that's why we think that ascending triangle is not going to be done. Triple top no longer there. So therefore, we think that the next thing is look at the wave theory. We think that the double tree corrective action is going to be the next feasible action after you complete ABC of the regular flat pattern. All right, so for that, we are looking for inroad to the upside first. All right, and it might retest 550 psychological resistance, and then after that, we'll make a 5 wave down of the zigzag wave, and then potential rebound will be at $500 or $481 Hong Kong dollars, which is the 127.2% of the whole W wave and X wave. All right, so if this support zone support zone 1 is broken, then we will look to long at support zone 2. All right, so more data will be needed to determine the price action for Tencent. All right, so next I will share on the two major Singapore stocks, the Top Glove and then AEM. So for Top Glove, I think based on our 31st August report, I think Top Glove has played out well despite Top Glove is have the what you call the ex dividend that which caused the repricing of the whole is aka like a stock split, but I am not very sure about this, so I need to check it out. But nonetheless, I think price did correct itself to the support level. ABC played out perfectly fine. As of this morning's Top Glove has a strong gap. Okay, so it is kind of like signal that ABC has really completed. The corrective wave has been completed, and then a bullish upside of the wave 3 of the strong motive wave is going to be is beginning. But we still are wary because the prices has yet to clear $3 psychological level, and if you need to clear that to actually see price to continue further upward, failure to clear above $3 will see price continue to a double tree corrective wave, which is kind of similar like what we've seen in the Tencent wave count. All right, so that do take note of the $3 resistance zone. Okay, so next, the last chart I'll be sharing for this session will be AEM. So AEM, as usual, I think I did a short call in, I think after a bearish candle, I think in mid August. All right, and then price did fall, and then for the zigzag ABC, smaller sub zigzag or ABC, and then price last Friday did test the support level at $3.40. Last Friday it had a strong upside. So for now, I think you need to look at I think that price will actually continue to test the resistance zone in the next few days, or maybe it will carry on into next week, unless the resistance zone is broken. Otherwise, I think that that the price is going to go into a larger corrective flat. We shall see. All right, so it need to break above the 50-day moving average. That's what is highlighted in. All right, so with that, I end off my presentation. I will pass my time to Paul. He will share on the Singapore Weekly. Thank you, Paul.
Thanks, Viren. Move on to our usual Singapore Weekly update. In terms of some of the key macro data, or at least for this time around, some of the key sector data, like the first bullet point, you can see that we got some data on the healthcare industry. So you can see that in July, private hospital admissions is still down, still down quite sharply, like down almost 19% year on year, somewhat similar to even June. And I guess on dental, I guess not many people going to the dentist, I guess, but it was down about 52%. We thought there would be some pent-up demand in dental, but it didn't happen. So healthcare is still kind of still very weak. You can see that even on the specialist numbers, the admission numbers also down about 18%. We have a chart later where let's explain a bit more. Then we also have received some data on the construction industry. Obviously, contracts awarded is still very weak. It's about down 75. But again, these numbers are very volatile, and obviously with the lockdown on the workers in the dormitories, I guess there's no point awarding any contracts. So these contracts include both the public sector and the private sector. The good news, at least for Singapore, is our foreign reserves actually hit a record high, about almost 300 plus billion. And year to date, we are also a record 50 billion. So it just shows that there's a lot of inflow or liquidity in the system. At least there's a lot of flows from overseas into Singapore. Just a quick update on oil. We don't make predictions on oil price, but I think there were some movements, and the prices was the lowest since June. Again, we'll show you a chart later after inventory build up, and we already passed the peak driving season in the US. So despite the peak demand, I think the prices were still very weak. In the US, of course, we are close to the final 50 days before the US November elections. So far, the odds are looking at the betting odds and looking at your favorite polls. It's still a positive win. It's still the odds are that Biden will win. A Biden win will be positive for Singapore, not just Singapore, but I think in general for all Asian assets and currencies. I think you will have less aggressive stance on foreign policy and less aggressive trade policy. So far, if you want to calculate the odds, or if you want to go and bet, the bet is like 54% odds that the Biden will win. I think in terms of news, you probably will see a lot of there'll be 3 debates coming up, but I think as you know, Hillary actually won the 2016 debate, but I guess we know what was the outcome for that. So debates probably more to generate advertisement revenue and maybe more to generate a lot of hype through the media. But in terms of the impact elections, I think it's shown that it hasn't really impacted the voters' view of the elections. In terms of our tactical view, we are cautious. I think although we do get a V-shape recovery, but it's still soft on a year-on-year basis. I think you will see the healthcare numbers, construction numbers, even bank loans growth numbers, everything year-on-year is still very soft. So and what is happening also, the stimulus is also fading. As we move on to the fourth quarter, the stimulus fades and the economic recovery is a bit more lackluster than we thought. And then with the US upcoming elections, the race is still close, although odds is with Biden. But when you have a race that's very tight, you could see a lot of investors sideline until we get the outcome. And also the other negative news is, of course, we're getting a resurgence in COVID cases, especially in Europe. We'll show you a chart later. The other thing that's overhanging the market is the stimulus plans out of the US. So right now, this thing keeps on moving, but I think the most recent, I think, was about 500 to 700 billion planned by the Republicans. This is far below the stimulus we had in May and what Democrats. And the other negative is, of course, we got this so-called pending hard Brexit scenario, which is obviously not going to be good for the sterling and also not good for the developers that have exposure in the UK. In terms of the events to watch, of course, I guess if you look at 17 September, there will be the FOMC meeting. I think rates are already zero, so don't expect any rate cut. I guess the only thing will be he will just be discussing about the CPI, how does he look at, when you mentioned the average consumer price index, how does he view that in terms of before raising rates? I think probably there will be a lot more discussion on that, and of course, how his view on the economy. In terms of other events by Poems or Phillip, do note that, of course, tomorrow we have our straight trading webinar. And on the 3rd of October, which is a Saturday, we will have our quarterly strategy by our research department with 9:30 in the morning. And also, this is only for TRs, not because due to regulations, I think it's only for our trading reps, but there will be a CMT CCT webinar. Capital Mall Trust CCT on the details about the merger. Okay, anyway, as usual, we because of COVID, we have to do this weekly COVID watch. But I guess the thing to note is the red line, which is in Europe. I think after you can see that the numbers coming out from the new cases coming out from Europe is now even higher than the US. So, and also the global numbers, I think we saw the headlines today, it's about 300,000. What we have, the blue line is actually the weekly average. So you can see that we're probably going to likely going to hit another record high in terms of new cases. I guess if there's anything positive about this, will be it will help the glove makers. I think the cases remain elevated. The chart on the right is just to show you the resurgence. I think the problem we have now is the red line, which is the France. I guess that's why Neymar also got COVID. The number of cases in France is really skyrocketing. Although you see that 7,004, the latest number is 10,000. Because like you said, ours is a weekly average, so you continue to rise to weekly highs. So obviously this is not good. I mean globally, because this will only creates the risk of further lockdown and slowing down of the economy, of economies in Europe. Yeah. Okay. Next slide. Of course, again, more important is, of course, the cases in Singapore. So the good news is that thankfully, we are still hovering around 2 cases, and certain days we don't even have a case, community case. So we will still see more easing of the lockdown. But I guess the lockdown hasn't eased as much as what we would have liked. I thought the group numbers could, from 5 could hit to 10 right now, but it doesn't seem to be the case. But I guess we will be having conferences and so on. So the easing of our lockdowns is still happening, but at a gradual and cautionary pace. Okay, anyway, this is just a chart on construction. It's quite a bleak chart, I guess. But I think we are not so negative on construction. I think a lot of projects have not been cancelled. I think it's just been deferred. As you all know, a lot of the workers are stuck in the dorms. So there's no point in awarding anything, and nothing will be built, and nothing will be. But yeah, I mean, if you we think that there'll be some pent-up demand, and we do expect some rebound in the construction activity. Like the construction work coming out from resorts, all these things will not be cancelled; it will be deferred. So I think if the building materials, at least for us, we don't cover, but I think those still look good, because I think the recovery will be at least sharp, and at least there'll be some recovery we expect for the building materials. Okay, anyway, for healthcare, on the chart on the left is just the hospital admissions, the number of patients that go into hospitals. The blue line is public hospitals. So obviously the red line, you can see a sharp drop, almost 30%. Obviously, one of the reasons is the lack of foreign patients. Although most hospitals do not disclose the amount of foreign patient revenue, but I think IHH, that has Gleneagles, actually they disclose for, I think could be the first time they disclose that almost 26% of the Singapore hospitals revenue come from foreign patients. So you can see how huge it is, and this probably disappeared. Almost 20% of their revenue just disappeared. So it will take some time to recover if the borders are still closed. Then the chart on the right just shows you that not many people going to the dentist. I guess. The red line is like down 50%. Nothing much. I think that's just to show you that in terms of the financial conditions in Singapore, there's a huge amount of liquidity in Singapore, and I think there's no issue with our foreign reserves. The red line, the red bar line, you can see is just a cumulative. That means the past 12 months, how much foreign reserve have we accumulated? And you can see from the red bar, we are at record levels. Likewise for the blue line. So there's probably a lot of inflows overseas into our banking system. Okay, I know we don't cover all specifically, but I guess it's just to watch how the marine sector is performing. So anyway, the current situation from oil, I mean, there are many charts to use, but we just pick these two, shows that it's still oversupplied. The chart on the left just shows you in the US, motor vehicle miles traveled. Again, don't ask me how they compile this number. I'm really not sure, but this has been used for many, many years. But it just shows you the red line. So you can see the blue line and the so-called yellow line. Travel in the US usually don't really move much. I mean, 1%, 2%. But you can see that it collapsed, obviously, due to COVID. And even right now in June, you can see the V shape, but it's still really bad. It's still like down 13% year on year. So it takes a lot of time it's still on the contraction mode, even though we have this so-called V shape. So demand is hurt. And as a result, you can see that the crude inventory in the US is still elevated. So the blue line that shows you in week 37, usually last year, that is the blue line, but this time around, week 37 in 2020, it's about 500 million barrels. This is million barrels, yeah. 500 million barrels is up about 2 million. So I think the REIT here, the conclusion is all is still going to be it's still an oversupplied market, and obviously this is not going to help the marine sector. Anyway, this is my last slide. I think this is just to I know we have to monitor. I think just in case there's any risks of a Trump victory, I shouldn't say that. But anyway, the odds still favor Biden. I know it's a bit of a complicated chart on the one on the left, but it's just to track those who want to bet. So what it shows you that if you put in if you bet 100 and let's say $115, you only win $100 if you bet Biden. I mean, if you go to any betting sites. But anyway, the odds is that 54% odds that Biden will win. But the thing is that it's coming off from the July. July was much stronger odds for Biden to win. So the thing to read from this is that if it gets very close, then I think the market will be a bit more nervous, especially the US market. I mean, you're not sure which sectors will get hurt and so forth. So that could kind of keep investors sidelined if it gets too close of a race. The chart on the right is nothing much. Nobody believes in polls, nationwide polls. So you have to go to the individual states and see how those are polling. So you can see the polls, the poll for Biden versus Trump. It's still, apart from Florida, I think most of the battleground states still favor Biden. So odds are is that he will still win. And if you follow this person called Alan Lightman that predicted the 9 US presidents, I mean, he says that Biden will win. I mean, if you want to go and read out more. But anyway, that's it for me. We'll move on to Q&A. Thanks. Just read out and just answer. I don't have to
okay, sure. No, then I will just go by because we use the vote system, then I'll just go by top to bottom. So start with the first question. I think the first question by Harry is, I think it's for me. So on QAF and Silver Lake Axis, am I right? So just give me a moment while I share my chart. So guys, okay, just give me a hands up if you can see my chart on Silver Lake Axis.
Yeah, I can see. Thanks.
Okay, so okay, Harry. So for Silver Lake Axis, I think last two webinars ago, I said that that first of all the resistance zone has been really tested, fails to break and then has a slight reversal. Another thing is we are actually looking at if you look at Ichimoku. So we look at the short term 9 days. This is called a leading line. I only know in Japanese term, but for the English term, I'm not sure, so I need to look it up. So the 9 will cross over the 26. So once it cross upwards successfully, it will be the cross, and then followed by the cross on the lagging span, which is 26 days previously. So I think I think the candlestick has really closed above the 26 days. So we are looking at a pattern. So we are looking for a strong upside on the Silver Lake axis, and then another thing is well supported near to the cloud to the Kumo, which is the cloud which is near the leading span A. So despite all this, and then you look at the wave count, I think we are looking at third wave, fourth, and then we are looking at fifth wave that to 0.4. All right, 0.375 to 0.4 cents. All right, then next question we look at QAF. If you look at the upside on the chart, I think 127.2 has already been tested multiple times. All right, that's for one. And then next one is we are still maintaining our target, as I mentioned last week, that after a correction down, we are still looking to test 1.618, which is the resistance zone over here above $1. And then look at it. I think we are looking for QAF to test the support zone over here, support level between 0.085 to 0.865. All right. So that concludes my question. That concludes my answer. Yeah, thank you. Okay, then the next one is UG Healthcare. All right, UG now followed by Wilma. Okay, so UG for the on the daily chart, I think is well supported over here at 2.12 to $2 after a strong sell down, which we mentioned last week, but do take note of the corrective flat. So I think $2.88 to $3 is kind of the resistance zone here. Okay, let me see. All right, so you take it you take a Fibonacci downward. We are still in a very corrective phase. Prices need to break 2.73 in order to clear it. So I think 2.8 to 2.9, and the next one is $3. Will be actually the strongest resistance zone. And then we look at it. Okay, right now it's still in the corrective phase. But if you ask me, that I think the strongest support will be the better support will be 1.64 to 1.84. All right, so you look at that, and you'll be you look from the waist perspective, it'll be WXY, and then there'll be continued WX, and then maybe Y over here. All right, if not, then it'll be here, and then there will be a strong downside towards the support zone at 1.65 to 1.84. Right, thank you. Capital REIT. So Capital REIT, not much things. I think it's still on a very corrective phase. We have finished the upside. Prices fails to clear above $1.20. We are now currently on a range, but we are looking for price to actually test the support zone over here at around 0.88 to 0.91. That will be the strongest one, the stronger potential rebound zone in the long term. All right, that's for Capital REIT. Okay, so Wilma last week has a bullish hammer, but today it opened with a bearish tone. I think we are looking at the downside. I think last week, I think last webinar I mentioned that since its consolidation here at a support at 4.37 to 4.38, I think we are not looking for a continuation of upside. So it will be a very strong corrective downside. Looking at support 3.74 to 3.89. That will be the the midterm support zone. All right. And then lastly, I'll do on Thai Bev. Okay, Thai Bev, descending triangle support has been tested multiple times. I expect, so my previous report on the call based on the inverted head and shoulder is totally disregarded. I think has been stopped out. So I think we're looking at lower at 0.54 to 0.5. All right, so I think this one will be, I think the downside will definitely happen. Right, in order to confirm the upside, I think the price need to break 0.645, and that's a definite. But I think that prices has been ranging below 0.65 and 0.64. I think plus this is below the support resistance level at 0.63. I think Thai Bev is going for downside. All right. So I think the next question will be about CapitaLand. So I'm not sure if Natalie would like to comment on that first on CapitaLand.
For CapitaLand, yeah, our fundamental call is still a buy for CapitaLand. Yeah, the recovery in their major segments, such as China, is very promising. The pickup in the residential sales in China is also surpassed, basically on track to achieve their targets for this year. Yeah, so we're still positive on CapitaLand from a fundamental point of view.
Okay, so do the technical, and then after I'll pass to Terence on Sembcorp for Sembcorp. So I think last week I shared my slide. I think you can refer to last week webinar. It's on recording, so you can skip to the last part. I think the diamond pattern. I think we are still positive that CapitaLand is going to break on the upside because of the corrective pattern. All right, so we will see price testing the high side on 3.12. That's for CapitaLand. All right, thank you very much.
Yeah, so for Sembcorp's fair value, I think that's slide 7. Can we go to slide 7 so that it's clearer? Yeah, thanks, Warren. So for Sembcorp Industries, after the distribution in specie distribution of Sembcorp Marine shares to Sembcorp Industries shareholders, entitled as Sembcorp Industries shareholders, the ex-distribution price is actually $1.02, and so you arrive at $1.02 based on by stripping out the Sembcorp Marine equity value, and so based on stand-alone Sembcorp Industries equity value, we peg this to 0.7 times of their financial year 21 equity value. So the stand-alone Sembcorp Industries fair value should be $1.75. Viren, I think this next question is probably you.
Okay, move on to the next. If you wish to ask TA questions, just type the word TA. Otherwise, we will assume will be just fundamental questions. So the next question is, what's your take on Singtel? So for Singtel, I think it will be very weak. It will be a weak few quarters for them. The whole of 2020, you can more or less just write it off. Not just for Singtel, but for StarHub. The reason, number one is, as you know, international roaming is going to hurt the business, inbound and outbound. So when we travel overseas, if you're a Singtel customer, when you travel overseas, they earn very good margins when you go overseas and roam. Likewise, when when travelers come inbound, that they never disclose, but you think they could be 10-15% of revenue, but these are ultra high margin business because there's no cost, right? Even when someone comes in and tap into the Singtel network, there's no additional cost. It's almost just pure revenue for them. Of course, they will share. So that's number one. Then another thing unique for Singtel is the problem they're having in Australia. What has happened in Australia is the NBN network. Basically, a netlink has emerged in Australia. So the government has decided to provide fiber to all the homes. So once that happens, so Optus as a result will lose a high margin. So they used to provide connections through cable, and then now that they have to give these customers up, then they will lose the margins on that. Of course, they are being compensated a one-off, but the longer term hit is that the revenue profits are almost down 60-70%. And because the margin is lower, because you don't own the network, you're just a wholesaler. And then number two, you still bearing the cost of this cable. So although the so-called Australian netlink has appeared, you still have to maintain your current network. And of course you're going to be hemorrhaging money because you just lost like half your customer, but your cost still the same. So Singtel next 2-3 quarters will still be very weak. Yeah, sorry, that's a very long answer to a short question. Yeah, thanks.
There was a question on Fraser Centrepoint Trust pertaining to the fundraising for the acquisition. So maybe I'll just verbally say out my reply. So the question was whether or not the equity fundraising will be done via a rights issue and if the share price will fall. So the answer to this question is it will be partially funded by equity fundraising and done via private placement and preferential offering. So this is not a rights offering. Rights offering will be offered to all shareholders, but because it is only to, for example, preferential offering is only to selected shareholders. So therefore, it is only to a preferred group of shareholders. So not everyone will get it. And in terms of whether or not share price will fall, so as per the listing manual, the offer price cannot be more than 10% discount to the VWAP on the preceding day of the underwriting agreement, the signing of the underwriting agreement. So basically, this underwriting agreement will be signed after the approval at the EGM, and then the offer price for the equity fundraising cannot be more than 10% discount. So whether or not there will be a discount with regard to this fundraising, I think in most cases there will be a discount. It just depends on how much the discount will be. I don't think that it will be to the extreme of 10%. It's probably around the mid-range, perhaps 5% discount kind of range.
Okay, thank you, Nat. I think I'll answer the next question on iFast. So iFast has been on the subwave. I think we are on the extended wave 3 over here. So I think the correction, okay, let me just put up the 3. So we are being on a very strong extended third wave over here. And then, but if you look at the, the stock, I think we are still very much in the corrective wave despite despite the stock clear above $2. Psychological support level. Initially, we thought that the price going to fall to test the support zone at 1.91 to. Okay, so give me one. 1.91 to 1.99, or you can put it at $2. Okay, so initially we thought that, but price after piercing line of last Friday, today it has a strong gap up. So 2.4 to 2.45 will be the next support, the next resistance level to determine whether stock will make a new high to form wave 5 or not, or we are just going to be in a prolonged corrective flat again. All right, so that's for iFast.
Yes, there's a question on end. Sorry, we won't be able to help you on that because it's a Hong Kong stock, so not fair for us. You probably have to ask your dealer because or our Hong Kong office. Sorry for that.
Okay, the next question will be on Keppel. So Keppel is still on the downtrend as we have explained. So I think, pardon me about I think my neighbor is doing renovation. So we still think that what do you call Keppel is going to make correction all the way to below $4. Right, that's for Apple. Keppel, sorry, not Apple. Right. Apple I'll share later on during my webinar. Yeah. So Top Glove and Riverstone were stabilized. If you, I don't know what you mean, but Top Glove I already mentioned, you need to break above $3. Riverstone, I think is still the same. I think all the stocks, I think Top Glove or all the medical stocks, that I think Top Glove is the better performing. Because if you look at Riverstone, despite of the piercing line above, I think you need to clear above the 3.52 resistance level. I think failure to clear that will initiate more downside, and then I think we will look at the next support zone over here at between 2.28 to 2.47. That's the support zone. Despite this being a flag, all right, same as UG Health, which I shared earlier on. So Top Glove I've answered. So thank you very much. Your answer. Okay. So the next question is why return on asset in FY21 is lower. I don't know if it means that it's for Sembcorp or for Terrence or what.
I think Sembcorp industry.
I think
Okay, that's Sembcorp. So I pull out the slides for Sembcorp. So Terrence, just let me know which slide you want to refer to. Thank you.
Yeah, this slide is correct. Yeah, thanks, Viren.
Okay. Yeah.
So
Okay.
there's really two reasons for this. You can see that for Sembcorp Industries, we showed the reported FY19 figures and also the pro forma. So the pro forma and reported figures are actually tabulated by Sembcorp Industries. The way they did this is by using the net profit over total assets, whereas when we did a forward forecast for Sembcorp Industries, we use average total assets instead. So that's one difference. In our report on Sembcorp Industries, the distinction is clearer, but because this is just a overall summary, so we are not able to show everything. But on an apples to apples basis, then if we use that, so there are two reasons. So if we adjust for this, FY19's return on asset should actually be 0.9%. So we are seeing a doubling of return of assets for financial year 21. The second reason for the difference is an accounting adjustment for lease liabilities. So Sembcorp Industries don't include lease liabilities. Is an accounting adjustment, so they don't include lease liabilities under their total assets. But we've included this because we think it gives a more accurate depiction of Sembcorp Industries' total assets, which is why there's a slight variation. But please look at the report. It will be clearer in terms of the distinction between both.
Okay, so Chris has a question on the Sheng Siong. I think I prepared a slide. So for Sheng Siong, I think we are looking for further correction to 1.52. And then if you look at the Ichimoku, which I have done just now, I think first of all, the 26-day line, has crossed below. I mean, the 9 has closed below the 26-day line. And then the lagging span has already closed, has already break below the candlestick. So we are looking at a death cross of the Ichimoku. And then the next thing is we have already broken all the cloud. So technically, I think we are looking at deeper correction. All right, so the next one, if you look at the extension, you look at Fibonacci, we look at extension, I think 2 and 1.6, I think 1.58 is broken, then we're looking to test deeper to 1.52 or even further to 1.43. That's for Sheng Siong. So support level 1.52 to 1.50. All right, so that's for Sheng Siong. Okay, and then I think the next question is about Sembcorp India investment. I think Terrence, you want to take that?
Sure. So the question is how many percentage contribution to Sembcorp India investment if listed? I'm guessing this is profit contribution. So the listing is not done yet. They've not announced the deal details as well. So in what form the IPO will take, we are not sure yet. But just to answer from a general perspective, Sembcorp India currently contributes about just less than 10% of total of Sembcorp Industries' total profit. So to know how they will contribute post listing, we'll need to look at in what form the listing will take. Weiren, I think the next one is for you. TA for Singapore EDEF.
I'm not very sure about this stock. Anybody know about this? Like their stock code or something?
Yep, maybe you can put down the stock code for if you want the
you
TA
have.
for
So
this.
because certain stock we are not very familiar with. Thank you. So I think I'll answer this one, Lily, later on. So after you tell me the stock code, I'll put in the chat also, can put in the in the Q&A. So I think the next one on DBS UOB, I think let me know if you want to know what's your FA or TA. If it's a fundamental, I think I'll pass on to my colleague Wee Kwong. He'll answer it. Thank you.
Okay, I think that there are. So there's a question on to help cover DBS on UOB. So I'll just talk about the fundamentals. Fundamentally for DBS wise, right now they are sitting on about $1 billion worth of unrealized profits from their investment holdings. So this will help to buffer their top line in the maybe near term. For UOB wise, what I would say the bright spot for them is that their SP, so their specific provisions, hasn't really been has been kept quite low at a low level compared to DBS and OCBC. So these are two different good things for them during this period of time. But what we do see is that generally for the local banks, they are on a track to recovery, although it's a bit slower because of the net interest margins being suppressed for a long period of time. So we will need to see for their non-interest income, which again, like I said, for DBS, they have the investment holdings to buffer for them. For UOB, they will need to count on their wealth management business to recover probably. Overall wise, generally it will be a slow and gradual recovery. At least if you're looking at an investment horizon of about maybe half a year, 1 year, I would say that's when you start to see the recovery coming in.
So I carry on the technical of the banks. So banks are currently ranging for now. DBS still trading above $20, which is like kind of the signs of relief. And then if you look at this consolidation here, although it's been trending below the Ichimoku and the moving averages, I think it's forming a consolidation. So we are not sure that whether it's going to break on the upside or not. So the upside, I think if there's a upside, right, like there's a little luck on the upside, I think the resistance will still return to $21 to $22. The high 21.75 to 22.05 resistance level zone, and then we'll see how is it. Okay, but immediately I think we are still in the consolidation. It's like SDI. The SDI is still on the downside. So I think UOB is will show a clearer picture. Okay, so I think UOB is also showing the same thing, but UOB is much more of a downside actually. So but normally if you look at the technicals of the banks, I think if you put UOB and DBS side by side, I think most of them they move in tandem together. So either one, I think they will just move together. All right, that's for the banks. Thank you. So for Lily, I think your question means for Singapore EDF. I don't know if it means city development. Okay, let's take that is zero city development. So city development, okay, also on the consolidation. I think the support it has been tested a lot of time. All right, 7.78 and to $8, $7.90. So I think there is, and some more. I think we have been the price has broken out. So I think there will be still a downside to actually $6.69. All right, in the midterm. All right, that's for that. All right, thank you. Sorry, I just saw a question. Thank you. So for that, I think it's on the downside. All right, still supported, but do take note that for EDF, is on the corrective flag pattern. So if you want to confirm the upside, I think first you need break 0.071 and then followed by 0.078. So the best thing is you close about 0.089 in the midterm. Or then otherwise, if this level is being rejected, then we'll see a further downside. All right, thank you. So there's our next question. What's the view on Capital Mall Trust?
Not sure if this question is for me, but our call on capital, we have a positive call on CapitaLand. I think it's accumulate.
Okay, so like what Natalie has mentioned, I think Capital More is we still maintain our buy and it's a good buy. First of all, you look at the technical. We have broken out of the. I mean, first, let's go back in history. We have broken out of the inverted head and shoulder. This is the one I'm not going to draw due to time constraint. And then after that, we have a deep correction, the falling wedge, and we broke out. Next, we have the ascending triangle. So I think price did correct. They have a rejection at $2, as we mentioned last week and 2 weeks ago. And then I think price is going to make a higher edge to test the 2.33 in the long run. All right, so this will be that. And then another thing is recently we have seen the price actually return up above the 50-day moving average, and then we are slowly edging on to the 200-day moving average as well. Right, so that's for CMT. And then hi Paul, this I know this question, but for high paying dividend stocks will be recommended. Do you have any take on that, Paul?
Yeah, only for high-paying dividend stock, I think like Natalie mentioned, the real clear buy, the on absolute terms, absolute attractive yield is obviously the US REITs. I think these are US denominated assets backed by backed by tier one office assets paying you 8% US dollar return. I think this to us is probably our highest conviction bet on terms of dividend yield. And like Natalie mentioned, this is a 5-year wheel. So every year, let's say 20% of. So on paper, what it means that 20% is only going to be renegotiated. So even if you assume like half the rental rates drop by half, you're still going to get like 7% yield. So and also with unemployment starting to creep out again, we just think that the yield is very attractive for the US REITs. And I think the next leg, if they go through this whole series, this whole weakness without any major, which we don't think any major default, any tenants leaving, I think these US REITs could be re-rated because they basically been stress tested under a recession in the US, and the tenants are still there. So you could get two legs up. I mean, you could get the people will value this because of the high yield, and then secondly, there could be a positive re-rating for this stock because you just gone through a recession and your tenants are still all there. So that's how we view the US REITs.
Okay, I quickly take on the next question on James. VCOM. VCOM is still on the downtrend. Yes, you're right. Because first, we do have on the mid-August, I think, which is around last month, during 13th of August, I think we have see a long leg dragonfly doji, but it subsequently didn't clear. It just cleared a halfway path of the strong gap, and then it consolidated, and then after that it broke downward. So we are foresee that price will going to break $2 downside again. Right. So the last one before I take a break. All right. So I'll do Gili, one of Hong Kong stocks. I think Gili I mentioned. I think we are very much in a corrective flat pattern. So I think look at it, it will be a symmetrical triangle, or you can call it a pennant. Upside is definitely there, but once it's confirmed, I think it will be on downside. I think if it breaks below the pennant boundary, I think it will form a flag which will test the support zone, which is a gap zone at $14 to $14.18 to $14.74. Right. I hope that answers your question. Thank you. Then I pass on the question. So any comments on why DBS price more than $1 above UOB now? Wee Guang, do you have any take on that?
Okay. So I think we should try to understand the difference in prices. You cannot just look at the flat share price. Of course, you need to look at the market cap. We already know that DBS is the biggest bank in Singapore. And if you want to compare share prices, you need to look at the number of shares they have and per share how much they have, and then you times together, that's the market cap for them. Yeah. So what I can say is why maybe if you really want to do plain comparison of why maybe DBS didn't fall as much as UOB over the past few months. I think the whole COVID-19 situation has shown that DBS is a very strong, has a very resilient, not strong, more resilient earnings capability in terms of their top line compared to UOB. Whereas UOB, in terms of their business momentum, it has slowed down more than the other two banks are. So that's why you see that in terms of price, they are seeing some more weakness compared to DBS, where more people believe that. That's what I believe that most people think that when during the recovery period, DBS earnings growth will recover faster compared to the rest of the two banks. Yeah. So that's it for me.
So I'll take on the yen lot question. So yen lot has already closed below 200-day moving average just I think last Thursday, then Friday, and then today. So the downside based on the cloud and the Ichimoku, okay, I think we are still looking at downtrend, further correction downside to support level at 1.09. All right, that's our take on that. Okay, and then next one will be I'll do Avra, I think corrective movement. Upside, let's look at it. I think will be on the upside. I think once this crossover, once the 29-day line, 9-day line cross below the 26-day line or the Ichimoku, I think they'll signal a first pre-warning on the further correction downside. All right, but look at the support zone over here. It's been tested once, tested twice, and then this will be the third time. So it's really break over. I think there will be a very downside. All right, thank you.
Yeah, I'll try help you out as you take a breather. There's some question. What are your thoughts on the SPDR STI ETF versus the Phillip Sing Income ETF? Which is better? Anyway, the SPDR STI ETF, it just replicates the STI index. Whereas the Phillip Sing, they put more weight on those stocks that pay dividends. So just to give you a flavor, so one of the top holdings in the Phillip Sing Income ETF is SGX. So the weight there is about 10%, whereas on the STI, the STI ETF is about 3%. So because SGX pay higher dividends, so they will weigh more. They will allocate more the weight more to the ETFs, to this higher paying dividend stocks. And one notable thing that you get from but you don't get, at least from the FinCEN, is that you don't get the Jardine conglomerates. So a lot of the Jardine stocks that are in the STI ETF is not in this Sing Income ETF. And inside the Sing Income ETF, you get net link trust, and yeah. I mean, better, we are a bit biased as Phillip, right? So obviously we think that that's better because you get higher yielding, but again, just take it with a pinch of salt. So it's just more skewed. The other one you can think of is the Lion Phillip REIT ETF. I think the only difference I can say, at least my own view, is that because right now all these ETFs, be it the Phillip Sing or even the STI ETF, you're being burdened by low interest rates. So, the low interest rates affect the banks. So as a result, the banks will be a bit sluggish when interest rates remain low. But it's the most conducive environment for the REIT ETFs because low interest rates benefit them. I mean, yeah, that's my thing. But again, this is a Phillip product, so take it with a pinch of salt. Thanks.
Okay, I'll continue. Will venture hit back to above $20 in short term? I think venture, last Friday, I issued a short call on venture. So I think the short is still on, still in effect unless price every break 19.54. The reason why I issue a short call is because I think it closed halfway of the gap or the bearish gap. And then after that, I think the bullish engulfing didn't really make some effort despite on a support level at 18.48. All right, and then if you look at it, I think I mentioned before that we are on the ascendant wave 5, so which means that the correction of ABC will be much stronger than usual. So I think going back to $20 in short term will, but I think it would, if there is a chance of it going back to $20, right? I think $20 will be a huge selling level as well. So I think you need more data. So I think we shall see on that. So for venture, based on a technical point of view. And then next one will be Hong Kong land. So for Hong Kong Land has been on a corrective phase for very long. So if you look at it, we have 0A, A, there will be, and then we have some sort of running flat. I think we'll be on a double tree. I think the corrective flat will be on or still carry on. So I think more data will be needed. All right. So upside will be capped at $4.19 to $4.25. All right. That's for Hong Kong Land. Then I'll do at Yoma before I continue. So for Yoma has already broken out of the uptrend line. I think overall trend, I think is right now the start of a new downtrend after stock actually have a sell off on here. So once it's broke off, I think the next support we're going to look at is 0.250. So whether this support will hold, if this support holds, then we'll see a potential upside again. If not, then we'll see another potential support at 0.2 in the midterm. Right, that's for Yoma. So for UOL, same thing. I think this is my password, so you can just disregard it. So UOL will be on, I think it's like double tree corrective flat as well. There will be a consolidation. This one resemble like the what you call it, capital land, right? A diamond pattern. So upside will be testing a resistance zone at $0.699 to $7 once again. So for Tianjin, I think bullish cross, but price has been correcting below the 50-day moving average. So we are looking at a potential correction further. So let's see if this price level will hold or not. Right, if this holds and will upside, then this corrective wedge will take form. Otherwise, more data will be needed for Tianjin. All right, thank you. Next question will be Capital Land China Retail Trust. Thank you.
Hi, sorry, I have no comment for Capital Land Retail China Trust. So as we have no coverage on it. Thanks.
I think you just take 2 or 3 more. I think because you got to get yourself ready for the next presentation. I think you just take.
Yeah, sure.
Okay, there's one general question. Is there an announcement on forthcoming IPO on Poems? I'm not sure which one you're referring to, but I guess the big IPO everyone's talking about is the N Financial. So I'm not sure if that is what you're referring to. I mean, there was one question on forthcoming IPO. I don't expect any IPOs in Singapore. I mean, so the big one is in Hong Kong, the N Financial.
Jie Hui, I think there's a fundamental question on Yoma again. So Jie Hui, if you're there, could you take it? Yeah, thank you.
Oh, okay. Hi. So regarding Yoma, right? Okay. So the question is, hang on. The question is, can you help cover on Yoma's stock on both FA and TA? I think we already answered the TA portion, so I'll just touch on the FA portion. So for the FA portion, we still like Yoma because it's entrenched in Myanmar's most attractive and fast-growing consumer segments, like for example, the mobile finance, property, and motor vehicle segment. Amidst COVID-19, as in like for the quarter that passed, Yoma actually maintain their top line. Is pretty well supported by the unrecognized revenue from its property development segment, and then because of this, right, their Yoma Land segment actually held up, and then not only that, their Yoma Motors segment also did well. They actually registered a revenue growth of 33%, largely attributable to the heavy equipment segment, because last year they actually had a monsoon, and then this time around, because of pent-up demand, they're actually seeing a lot more sales in the heavy equipment segment. I think overall, right, I would think that Yoma is actually a recovery play on the Myanmar side, and then we still think that Myanmar is a good place, it's a good place to ride on the, as in Yoma will be a good place to ride on the growth of Myanmar. So we are still maintaining a buy at a target price of 46 cents.
Yeah. Anyway, just to help, just to add on to Jie Hui, Yoma is just buying Myanmar. I mean, you buy Yoma because they've got the best business, some of the best businesses that you can have in Myanmar, such an undeveloped country. So the thing to watch for will be will be the upcoming elections. So I think if there's no major changes, anything, nothing chaotic, which don't seem to be, then I think that could help trigger more interest in Myanmar. Let's move on. There was a question on, just to give Viren a breather, there's a question on United Hampshire. Can anyone help? So how we view, although we don't cover, but at least what are your initial thoughts?
I'll take the question on United Hampshire. So, for those who don't know, United Hampshire is it's a grocery store REIT, and it also owns some strip kind of assets, which are basically like the one-story, very large open-air kind of assets that house a lot of your necessity kind of retail, your hairdressers, your laundromats, etc. in the US. So, they have about 12 assets in the US. So of course, this is a very defensive kind of investment, and the whales, if I'm not wrong, for this REIT is also relatively long, and of course, one of the things that was we had a call with them, or rather we had a presentation with them last week. And one of the interesting things that the CEO actually mentioned and emphasized was that this is one. For the grocery anchored kind of assets, this is one of the trade segments that is not, the e-commerce cannot exactly penetrate, because it is, first of all, already a very, very low margin kind of trade. It's necessity kind of goods, and it's already a low margin trade. So whereas it is more, the only other way that in which another person can make this grocery stores sort of e-commerce is like to hire a third party kind of delivery party. Other than that, the supermarkets are still relevant, and they have also evolved throughout this COVID period, such as they've offered other modes of sort of delivery, in a sense like they have ordering as well as curbside pickup, or where the customer just orders online and then drives by to pick it up. So in a sense, this, first of all, is already in a very defensive kind of asset class, and second of all, it is something that is not going to be able to be disrupted very much by e-commerce. So of course, we agree with the management and that it is sort of defensive kind of asset. So I think one of the things that we do not have coverage on United Hampshire, but I think one of the things that the management said was, because United Hampshire is currently trading at about 20% down from pre-COVID prices, and so they think that it's probably because the investors are looking at United Hampshire similar to how they view other retail, when actually they are not really the same kind of asset class. One is more defensive and the other is more discretionary. Okay, so our overall thoughts on United Hampshire is that we do like the asset class, and also the defensiveness of this REIT.
Yeah, okay. I'll just quickly try to answer this. Which is your preferred REIT, First or Parkway? I think Parkway would be better, but anyway, every week we get a question on First REIT. But let me just lay out what is happening for First REIT, hopefully so that everyone can truly understand. So firstly, as you know, First REIT collects rent from Indonesian hospitals and a few other nursing homes in Singapore, but that's smaller. So they collect rent from Indonesian hospitals. So the challenge number one is the revenue from Indonesian hospitals are down 40%. Okay, so that's problem number one. Then problem number two is what happens is that First REIT will collect the rental from the Indonesian hospitals, $1, but the parent Lipo will subsidize another $4. Then First REIT will get this $5 in rental. So you get what I mean, right? So $1, then Lipo will top up 4 times more. Yeah. So as a result, this whole thing has to be unraveled because Lipo is no longer the parent, and they're not going to subsidize this $4 of additional. So the real rental they're actually collecting is only that $1. So and all this will be expiring in August and December. So until that kind of unravels or this time is resolved, I think the best is just to sideline on First REIT, unless you know something. Otherwise, the economics don't work. So the yield is just going to collapse. And unless suddenly the Indonesian hospitals get flooded with a lot of patients. And these patients are paying you Sing dollars. So until that happens, I think it will be a very, very challenging environment for First REIT. The reason why we are clear on this because we've been asked many times. I think no issue for us to answer, but I just wanted to make sure everyone is clear that there's a lot of challenges ahead for First REIT from our point of view. Viren, I think you just take 2 or 3 more technicals. Then, if you got more questions, I think just post it on our community page. Because sorry to always cut you guys off because 1 o'clock Viren has another very extensive TA webinar, and we don't want to take too much of his time. A bit heavy for him, 2 hours. Viren, you want to take 1 or 2 more, then I think we can call it a day.
Okay. Okay, sure. Thank you, Paul, for the understanding. So I'll take on the last question. I think I look through. I think I'll cover Jardine, as most of you ask. So Jardine is already tested on the support at 17.62, just as we expected. However, the rebound wasn't that strong. So I think we are still continuing on the downtrend instead. And although it looked like head and shoulder on the downtrend and may not be visible, but I don't know. But I think that since it broke off the resistance at 19.19, I think we'll continue on the downside. Let's observe because of the momentum. All right. So I think that's end of my presentation on the technical part. I think if you're interested on the US side, you can join my webinar at 1 p.m. The link can be found on the Poem's website. You can register and hop on. We'll start at 1 p.m. All right. So if there's no further question, I'll hand over my closing time to Paul. And then Paul, do you have anything to add on?
Anything, thanks for everyone. We got this question on if Singapore or US both coming, is there a calendar feature that could place where IPO? Let us think about it, whether we can put it in our morning note. But the reason why we don't put it is because Singapore got no IPO, hardly any IPO. So ours is we are very Singapore centric. But we will try to see if there's any way to just include it in our weekly meeting. I think we will try to just try to get. I know someone asked about schedules of IPO. We will try to just maybe there's a Bloomberg function that we can just download and show everyone. And it's mainly US. So thanks for the feedback. We will look into it. So thank you for all this feedback. If it's very easy to auto download, I think no reason why we shouldn't include IPOs. But let us see. Okay. Anyway, thanks everyone for your participation. We hope to see you 11:15. And do sign up for our usual webinars that we have with the listed companies. Thanks again. Really appreciate everybody taking your time. I hope to see you soon and stay safe. Thank you. Bye-bye.